And so Paulson, Bernanke, they're all forcing the banks to take equity that they really don't need because they're trying to restore confidence.
As we were all brought in the room, Hank Paulson said, you know, there's some of you here who need this money and some of you here who don't. But we believe if we give it to everyone, the industry will, the perception will be the industry is now safe and secure. Everyone will feel better about it, and liquidity will come back to the market, and, you know, we can hold hands and sing Kumbaya. He didn't exactly say that last part.
Their logic was they thought there was a panic going on, and if they didn't bail out the bad banks, then that would become contagious for the good banks. That was simply not factually correct. At BB&T, we were buried with cash.
So this was 3 weeks after Lehman, you know, so the market had already settled down. The stock market had gone down about 5%, so everything was fine. I mean, it was, you know, there were some investment banks who were having liquidity problems. But the market knew who needed it and who didn't.
Bernanke, who was head of the Federal Reserve, he was a student of the Great Depression. And in the Depression, they had tried to save individual banks, and it hadn't worked. So there were 3 or 4 large banks getting ready to fail. He was scared if he tried to save those, the market would jump on them. So he had to force the healthy banks to participate. So banks like Wells Fargo and Bank of New York and BB&T, we were forced to participate. We were basically told, you know, participate or go out of business.
And when it came to me, I said, you're going to give Wells Fargo $25 billion? I says, the opposite is going to happen. It's going to be a disaster. It's going to shatter the confidence in the industry, not help it.
We were basically forced to take Tarp. And the way that worked was our regulator contacted me and said, look, John, you guys have a lot more capital than you need based on our historical lending, capital standards. But we've decided we need new capital standards, and we don't know what they are. And we've got an audit team coming in, and if you don't take Tarp, we'll send the audit team in tomorrow, which was a clear message they were going to shut us down if we didn't take the Tarp money.
So when I was ranting and raving in that meeting saying, don't do this, Hank looks over at Bernanke, says, your primary regulator is over here. If you don't take this money, we're going to declare you capital deficient on Monday morning. This is America. So you sign the papers.
Good banks didn't want it, but they were told they had to go along and play along, or there would be retaliation. And I just don't think that's not how you run a government. It was really awful.
So what happened? So within 3 weeks of Tarp money, the stock market fell by 40%, bank stocks by 80%, including Wells Fargo. Everybody went down together. Now, how can you say giving Tarp increased confidence when you have that happen? We were forced to take $25 billion. We never used a nickel of the $25 billion. We paid it back within 1 year and paid them $2.5 billion in interest and in warrants for money we never wanted or never used.
Paulson forced the healthy banks to pay these enormous killer interest rates, so it was a bailout of unhealthy banks at the expense of healthy banks.
Now, the conventional wisdom is Tarp was a great success. It wasn't. It was an unmitigated disaster. Tarp caused the markets to collapse. There was no liquidity in the markets. The Fed had to put $2 trillion into it. And what about the small investor who saw their bank stocks fall by 80%? They got absolutely killed for no good reason. So they demonized and vilified the entire industry. They institutionalized too big to fail forever, increased moral hazard. You got the 1% and the 99%.
We ought to look very carefully at what happened in the financial crisis to make sure that we really understand what happened here, because we're saying a lot of things in this country, especially here in Washington, to the effect that we bailed out these big banks, and so we ought to be exacting a lot of blood and treasure from them because we kept them from failing. It's very, very, very unlikely that these banks would have failed if they hadn't gotten this infusion of money.
So what we have here, and this is the biggest danger of this crisis, is arbitrary decisions occurring, and therefore regulators and politicians picking winners and losers. In a world where everyone in Washington likes to extol the virtues of capitalism and free markets, yet they're picking winners and losers, they're creating two classes. Animal farm, right? All pigs are created equal, some are more equal than others.
So now we've got the same guys who just created this whole mess, putting their heads together to come up with a whole new crop of guidelines, agencies, mandates, and wish lists that we absolutely need to ensure that nothing like what they just did will ever happen again.
You should never underestimate the hypocrisy of politicians. The same individuals who play key roles in creating this sort of freight train that runs off a cliff get their name attached to the reform bill that's supposed to save us all.
First, it's an irony. The two biggest culprits that caused the financial crisis were Dodd Frank. They were the ones that were supporting the subprime lending business in the U.S. and force spreading Fannie to subprime. So you have the two worst characters, quote, creating the law.
Dodd Frank is punishing 7,500 commercial banks who did no wrong, who were not tempted to put their customers at risk with subprime mortgages.
And then secondly, the law didn't deal with any of the real issues. The Federal Reserve always had plenty of power to deal with these questions. They just didn't see it coming. And in fact, Bernanke was saying the economy was healthy after the recession had started.
This, in my opinion, was a cover-up by Washington and the organizations there to try to push the blame onto the commercial banking industry who did no wrong.
A lot of Dodd Frank requires regulators to collect data. Collect millions of data points. What are they going to do with them? They don't. The truth of it is, I know, I mean, from experience that I've had working in financial markets, you really only understand what's going on when you're working in them. When you're sat outside, you don't really understand. It's vastly complicated. You have PhDs, banks go out and they want PhDs in maths and physics. PhDs in maths and physics aren't working at the regulators.
There's more talent on Wall Street at exploiting those kind of loopholes than there could possibly be at closing those kind of loopholes. It's a kind of a mug's game to think that the more complicated we make the system, the more it's going to serve the average consumer. Quite the contrary.
Mainstream commercial banks have been making reasonably and sometimes low, not 3%, but you know, small down payments forever. We know how to do that. But because of Dodd Frank legislation that says that if you make a loan to somebody who can't pay it back, you can get sued at multiple times, the litigation risk, at multiple times the credit losses. Banks said, I'm not going to take that risk anymore. Of course there's going to be some of these going bad.
First, the government pressures banks to loan money to anyone with a pulse. Now they pass a law saying you can be sued if they don't pay you back.
We know how to analyze credit risk. We do not know how to analyze litigation risk.
Meanwhile, public outrage toward Washington and the big banks reaches a boiling point.
They believe that the banks were bailed out, Wall Street was bailed out, Main Street was not. They wanted scalps. They wanted people to go to jail.
Suddenly, it's open season on banks. The Department of Justice is given a mandate to aggressively pursue and prosecute banks for alleged improprieties. The fact that most of the banks being pursued have done nothing wrong is overlooked in the rush to see justice done.
They've started going through all the mortgages, and they found some information like maybe a misspelling of the name of the applicant, maybe a transposition error in an address, maybe a date that was wrong. And so they used that information to say that the application was wrong.
The banks, of course, have the option to go to court to defend themselves, but that involves a lengthy process, and the public wants action now. The government threatens to prosecute banks under the False Claims Act.
And what the False Claim Act says is that if you do something wrong with the government and supply information that is incorrect, the damages are triple the actual damages.
That means any erroneous information on a mortgage, no matter how trivial, can result in a bank being assessed triple the actual damages.
So, for example, J.P. Morgan actually got a fine of $13 billion. If they would have gone through the process and the fine was determined to be 13, they had to pay $39 billion. Bank of America's was 17, they'd have to pay 54 billion. This was real money.
Faced with these choices, and with public sentiment running strongly against them, banks opt reluctantly to pay the fines. The public sees this as an open admission of guilt, further damaging their already tarnished reputation.
The vilifying and demonizing of financial institutions who are really innocent, who did not
participate in this, is a tragedy, I think, for the country. And for the confidence that people have in the free enterprise system, which has given the greatest wealth to the most people in the history of the world.
In my 40-year career, there's been greed on Wall Street every day. There's not one shred of evidence there was any more greed than usual. Somebody just made that up. So that's not what caused the financial crisis. In fact, the financial crisis was primarily caused by government policy.
This is what happens with politics all the time. They come up with programs that they know will fail. They push them because they sound good. And when they fail, they blame somebody else.
Banking is the most regulated industry in the U.S. It is the most regulated industry in the world. It's not surprising that the crisis happened in the most regulated industry.
You cannot blame people for taking advantage of a broken system. I mean, you can blame them, but that does not fix the broken system.